Market to Market is everywhere you are. Subscribe to Market on YouTube, find us on the PBS video app to stream on demand, and add our 3 podcasts on your favorite podcasting app.
This is the Friday, August 6, 2021 version of the Market Plus segment. Joining us now, Don Rose. And Don, you talked during the broadcast, and the limitations of time. We talked about the government report a year ago, and I said it in the show, Tuesday will be the 1-year anniversary of the derecho. We've talked about it. You've sat right here to my right during a panel program, and we've talked about how different the end of July to August and to the point we're in now, how the market has been. That derecho threw a lot of things off. Is that the only excuse for maybe some government reports and numbers not matching up with where we think are going to go? I mean, we saw this derecho just hammer so many acres. Nobody was going to be able to guess on that thing, but the government still tries.
Well, they do, and last year they did. They put the biggest yield estimate we've ever seen, 181.5 on corn. And I think you can say probably some of the issue is they were using kernel counts. Well, it wasn't the kernels, and the kernels were there, but the weight wasn't. So I guess you can say that was some of the issue. And this year, when you look at it, they've got a price of $5.60 a bushel. So is that going to be adjusted in the August report? And I think that's a good question. And the same thing on soybeans, they're $13.70 a bushel. And is that going to be adjusted? That's the average cash price, because that's with all the numbers they put out, then they analyze it and say, well, that should be this price. So we'll see.
How does one protect, prepare, get ready for a government report in these modern times, no matter the commodity?
Well, I think really what you do for most people, you look at your bottom line. And for a producer, what kind of margins are you trying to protect? And you say, how much risk do I want to take? And can I pay my expenses at this level? And then you come up with a formula. And what we're seeing a lot of people use right now is window contracts. So you have the up market and the down market, and you've got a policy in between. And in this uncertain right now, because we could go either way, Paul. We went either way last year, like we've talked about. You know, everybody was pretty bearish, think the market was going to come under a lot of pressure, and then the weather changed. And right now, we're in, I'd say, worse shape than we were last year at this time, overall the whole Corn Belt.
Because of drought?
Because of the dry drought conditions. And remember, down in North Carolina and some of those areas, too wet to start with. And the Eastern Corn Belt, now they're getting a little dry, but if they've had a problem, it was too wet early at the same time, right, too. So we've got a lot of uncertainty here yet, and we're going to find out this year what genetics are, what crop management by the producer does, a lot of fungicide, a lot of micromanagement of these crops. So it's going to be very interesting, another good test.
I'm going to micromanage the rest of this discussion with some questions. Ken in Michigan is our first question, and it is tied to something I almost asked during the show. He's asking, December corn has a gap at $5.90 and $4.75. He's asking, which one gets filled first?
Well, one, it's a good question because gaps often get filled, a big percentage of the time. The seasonalities on corn, there's no doubt, if you're looking at the seasonalities, are down on corn and soybeans to the first week of October. So you'd have to put a bet that is probably seasonalities what happens. Short term, with the weather the way it is, it doesn't take a lot to go fill the gap at 573.5. We just ran up there about 2 weeks ago and we only go to 573. So it's going to be this report that's going to give you the big chance, and probably if you're going to fill that gap, it's going to be short term, probably going to happen pretty quick.
All right. Ryan in Pleasantdale, Nebraska, another new questioner. Thank you, Ryan, for this one via Twitter. School me on options, he's saying, Don. If you have a hedge position, margin that position all year, then you grow no or little crop, then what? What happens to my paid-in margin if I have no grain to convert to a cash sale?
Well, if you have no grain and you had a futures position and it went against you, you have to pay that difference. And of course, you're paying that daily with the margins because remember, in the futures market, you're only putting up 5% of the value. His other question was really if I'm using options. If you're using options, if you just have a put bought, you've just bought the insurance policy, and if you spent 15 cents for your insurance policy, for like right now, $5 December corn calls are trading about 13 cents. So you can buy a put to protect yourself at $5. If it expires, you never get under $5. You spent your 13 cents, but you still have the cash product, and you didn't have to deliver a product you didn't have.
Okay, see, it's always about knowledge. This one is about market influencers, and if there is such a thing. Bradley in Upland, Nebraska, the 2012 corn market topped prior to the Pro Farmer Tour in mid-August. Should producers price additional bushels now or store and ignore in anticipation of this tour?
Well, one thing I can tell you is every year is different. The 2012 is much different. Last year was much different, and this year is the same. It's really going to be down to the weather, and more than ever, like we alluded to, the market, the big issue is the export pace. We have 1 billion bushels more exports than we had the prior year this year in corn and 600 million in soybeans. So if our demand isn't there, then you should, and we get some good weather, the market's probably going to erode. So those are the big two things you watch. I respect what you're saying about 2012. We were also up closer to $8, and we broke down. If you remember, we topped out, and where'd we go to? Off the board, wasn't it like 720 or something? So
it was some interesting times,
right.
No doubt, but it was a drive. That
dry.
would imagine the correlation that Bradley's asking about
Yep.
is, but that 2012 drought was a little different in terms of where it was, maybe centered more in corn market than it is this year. Fair?
Yeah, no, I think that's right. And, and the price stayed higher than we are right now even. And, and the same thing, China had a big drought.
Right.
This year we've got problems in Brazil. They probably lost 800 million bushels, so that's a big deal.
Were you looking ahead at my paper? Phil in Dresden, Ontario, Canada has a question about Brazil, Don. Brazil FOB soybean prices for September have become more expensive relative to the U.S. Does this mean American soybean exports will increase into China, much like last year, pushing November soybeans up again towards $14?
Well, I think if you're in the bull camp and the yield is sinks at all, and China comes into the market, which maybe they started to, if they're really going to come in and buy soybeans aggressively, meet the phase 1 agreement, by the way, not even talking about phase 2 yet, then I would say, you've got a good chance to the upside. But he is right. Right now, even actually into August here, the middle to the end of August, on into September, into January, we're 50 to 60 cents a bushel cheaper than Brazil. So our export pace should pick up. Are we going to pick up the total amount of exports that the government is saying, 400 million over 2 years ago? That's the big question mark.
Well, and there's another question that's similar, and this is Robert in Garwin, Iowa, asked us on Facebook, if we were so tight on soybeans, why doesn't the current price reflect that?
Well, I mean, what are you looking for a current price? Because the current price is, up at, new crop is like 13, 40, 50 cents a bushel. And I think that's the real question, Paul, is what is the fair market value with all these things? Just remember 2 years ago, we were talking about $8. Actually, in July, I remember that the trade was, we went under, we were fearful, oh my gosh, we could go $7.50.
Right.
So I think it's all perspective when you're asking what the price is, what is a good price. What should the price be? The government says $13.70. Well, so we're going to find out.
We'll go back to the beginning part of this discussion. But the farmer will tell you, and will tell us on Twitter, I'm sure, after we post this discussion, yes, the price is relatively higher than it was, but all my inputs are coming along. My landowner says, I see you're doing pretty good, $13. I think I'm going to ask for a raise in my rent this year. Those prices come along for the ride too. So again, it's harder to know what it's better to know what my break-even price is and where I can make some margins, right? Back
Right,
to what
and,
you
and,
said.
it's a moving target, and that's why you use some of these different kind of contracts that maybe don't lock yourself in tight. But along that, you talk about that December corn of 22 is getting close to 520. It was up like 10 cents on Friday, where this December was only up like 3. So new crop is starting to add some premium. That wasn't that positive for a market structure when you have bear spreads working like that, by the way.
All right, 2 quick questions here. One is similar to one we already talked about. Chad in Bagley, Minnesota. He says, basically, I'm a first-time farmer here. I have 890 acres of beans and a little over 400 acres of corn in the ground. 70% of it looks like it won't burn up if we get some rains in August. The other 30% shot. He's in northwest Minnesota. He said, what should my marketing plan be? I have no bins, so I'd have to pay storage when I haul it in.
Well, I would say one thing. If you don't have storage, you're always looking for where do I make cash sales, because it's hard to beat storage, particularly in soybeans with an inverted market. November soybeans are trading about a penny over July 22. So you can carry beans for 8 cents and lose a penny, not counting your interest in storage. So, so that's a problem. So you're looking to sell the cash. Take your ownership in options in a different way with call options, which is what we see producers doing. And the same thing with corn strategies, much the same. There's not a big carry in the market when you're in tight supplies like this.
All right, last question, and this one is about inflation. Jeff in central Nebraska tweeted at us, do you think with some carries in the market for new crop at the higher prices is due to inflation? Are we at new base levels of pricing until yields take another larger bump in trend?
Well, I think as far as the carries in the market, it's really not that strong. As far as inflation, in the 80s we had interest rates that were at 18%, and how we got there was the inflation of the 70s. So I think what you have to be careful of, I don't know how this would work with the big debt that we have around, but the way you cool inflation is by raising interest rates, and the Fed looks like they're watching that. They're saying 23, but that's what we did from the 70s to the 80s. History sometimes repeats itself.
It does, but it also didn't have a pandemic that was happening or maybe re-emerging. So we'll see how that one plays onto that one. Don Rose, good to see you. Thank you so much.
Thanks for inviting me, Paul.
Good to have you, and good to have all of you watching. So thank you very much. And next week, we hope you watch when we look at how combating a glut in the hemp market led to competition with recreational marijuana. And Arlen Suderman will join us to analyze the markets. Thank you, everybody, for watching. Have a great week.